In front of you is a tweet that I had put out, and I was basically explaining to my audience how to better risk manage your positions. And what you really want to be looking for is objective measures in the market that are based off of volatility, really. So in this example, what you do is you find the implied volatility of Bitcoin over a 30-day period, okay? And then you find the expected move from there by dividing the implied volatility by the square root of 365. Bitcoin trades 365 days per year, so that's what we're looking at. So what you can basically do as a crude measure is if you find the IV, the implied volatility, you divide it by 19.1, okay? And then that basically finds, the daily expected move. Then what you can do is if you then go to a chart, you can say, okay, well, if we go and find the Bitcoin IV now, okay, so we can look at it from, if we go to the block.co, they would have it here, and we find the 30-day one, and we see that it's at 57.12. So then we go 57.12 divided by 19.1. And the IV is 3, and the expected move is 3%. Okay. Obviously, what we're looking at the moment is a market that is exhibiting mania. So what can you do? Well, that initial daily move is only one standard deviation. Bitcoin trends when it's when Bitcoin is trending, it moves like 3 standard deviations sometimes. So what can you do? Well, you double it to find 2 standard deviations. So if we're looking at 3%, we're looking at 6%. And you can double it again to find 3 standard deviations. So this is basically how we start to factor in where the market could go. So this hasn't closed yet. That's the week. Sorry, let me go to the daily. So what we can look at is 3% to the downside. Let's just call it 2.9%. And then we can look at 3% to the upside. We'll call that. So these are the 2 prices that we're looking at for one standard deviation. Okay, and then if we draw a little line across here, we can see exactly what prices they are at. Okay, so what you can think of in this context is if you think that the market needs to, the volatility needs to come down a little bit, you can look at one standard deviation, if it trades to the upside, as a place to sell and mean revert. Or if it goes to the downside, you can look at it as a place to buy and mean revert. But then obviously what you might then be looking at is, okay, well, what if we think it's going to go 2 standard deviations? So we go down to 6%. And then we go up here on the upside, okay? And then you do the same. So that's for 2 standard deviations. So you have these objective levels that you can mark out that are based on actual volatility rather than eyeballing the chart. You can only do this for anything that has, options traded on it, because that's how it's calculated, which is most assets, to be fair. You can find the IV on CME website or wherever else they might be traded. So have a look at that, see if you can factor it in. Remember, the daily expected move is the 30-day IV divided by the square root of 365, which is 19.1 generally.